Hello and welcome. Today, we're going to be exploring two of the most popular tools in the futures market, the E-mini and the Micro E-mini contracts. In the world of trading, picking the right instrument is absolutely essential. And by the end of our time together, you'll have a very clear picture of how each one works, and more importantly, which one might be the right fit for you. And that really is the fundamental question, isn't it? Because the contract you choose to trade is your primary tool. The size of that tool has a direct impact on how you manage your capital, your exposure to risk, and ultimately, your ability to build a consistent, sustainable trading strategy over the long term.
So, to really appreciate these modern tools, it helps to understand the problem they were created to solve. For a very long time, the futures market was really the domain of large institutions. And the reason for that was simple. The standard contract sizes were just too big, requiring an amount of capital that was well beyond the reach of most individual traders.
Now, at its heart, a futures contract is a pretty straightforward concept. It's just an agreement to transact at a future date. But the classic versions of these contracts were, well, massive. They controlled such a large amount of the underlying asset that they were far too expensive and, frankly, too risky for an individual to handle, creating a real barrier to entry for the average person. The market eventually responded to this need for accessibility through innovation. It started in 1997 when the CME Group introduced the E-mini contract. This was a game changer, a smaller version of the standard that finally opened the door for more retail investors. Then, in 2019, they took it another step further, launching the Micro E-mini futures, which made the markets even more approachable for a whole new generation of traders. And this evolution is what gives us the two instruments we're focused on today. So let's dig into the specifics of how they compare, because it all comes down to a really simple and crucial 10-to-1 relationship.
This table really lays out the core difference between the two. If we use the S&P 500 futures as our example, you can see the E-mini has a contract multiplier of $50 per point. The Micro, on the other hand, has a multiplier of just $5. This single difference in size affects everything else you see here, from the tick value, which is the dollar value of the smallest possible price move, all the way down to the notional value, which is the total value of the market exposure that one contract gives you. And that brings us to the single most important concept to take away from all this, that 10-to-1 relationship. A Micro E-mini contract is exactly 1/10 the size, 1/10 the market exposure, and therefore 1/10 the financial risk of a standard E-mini. It's a simple ratio, but it's the key to understanding all the practical differences we're about to cover.
So now we'll explore how that 10-to-1 ratio actually plays out in the real world for a real trading account. This is where we move from theory to application and see just how much these contract sizes can affect your capital requirements and your risk on any given trade.
The first and most immediate impact you'll feel is on the margin. That's the amount of capital you need to have in your account just to open a position. For an E-mini, the day trading margin might be somewhere around $500, but for a micro contract, it could be as low as $50. You can see how that dramatically lowers the barrier to entry and gives traders with smaller accounts much more flexibility.
And this chart shows us the other side of that same coin, the profit and the loss. Let's say the S&P 500 makes a 10-point move. If you were holding one E-mini contract, that would translate to a $500 gain or loss. With a micro contract, that exact same market move results in a $50 gain or loss. This direct scaling makes your risk much more defined and manageable, which is incredibly important, especially for those who are still developing their skills.
Okay, so with all of these practical differences in mind, we can now come back to our central question. Which of these contracts is the right tool for you? And the answer to that really depends on your personal situation, your capital, your experience, and your specific goals as a trader.
Micro contracts are really an excellent tool for a few different kinds of traders. For beginners, they offer a way to get your feet wet and learn the mechanics of the market in a live environment, but with very minimal financial risk. They're also perfect for traders with smaller accounts or even experienced traders who want to test out a new strategy without committing a lot of capital. They also give you incredible flexibility to scale your positions in and out with precision.
E-minis, on the other hand, are pretty much the industry standard for more seasoned traders. They're best suited for those who have larger capital accounts and are comfortable managing a higher risk profile. Active day traders often prefer them because they offer very high liquidity and tight bid-ask spreads, which can lead to better trade execution. And of course, for a well-capitalized trader who is confident in their strategy, the E-mini provides much greater profit potential on every trade.
So, how do you make that final choice? Well, it really just comes down to a simple 3-step self-assessment. First, you need to be honest with yourself about your available capital.
Second, you have to clearly define your personal tolerance for risk. And third, you need to clarify your immediate goals. Are you here to learn, to test a new idea, or are you actively trying to maximize profits? Your answers will point you very clearly toward the contract that best aligns with your personal situation. And that really is the core takeaway. There is no single better contract here. The decision is a personal one, and it's tailored specifically to your individual journey in the markets. The best tool is simply the one that fits your current needs and allows you to execute your strategy both effectively and safely.
Understanding these instruments is the foundational step. From here, you can make a much more strategic and informed choice for your trading. The right contract gives you control over your risk and your capital, and in trading, that control is everything. So now that you know the tools, which one will you use to build your strategy?